Lowe's companies just delivered a quarter that looked strong on the surface. Sales came in at $20.6 billion. Comparable store sales, that's sales at stores open at least a year, rose 1.3%. Adjusted earnings per share were $1.98. All of that beat expectations. And then this stock fell. On the same morning, February 25, 2026, the company told investors something they didn't want to hear. For the full fiscal year 2026, Lowe's expects comparable sales to be flat to up just 2%. Earnings are projected at $12.25 to $12.75 per share. Total sales are guided to roughly $92 to $94 billion. That EPS midpoint, about $12.50, sits below prior consensus estimates of around $12.95. Here's what changed financially. The quarter didn't deteriorate, the future did. Revenue expectations for the year effectively reset lower, not collapsing, not shrinking dramatically, but clearly softer than Wall Street had penciled in. And this is why it matters. When a retailer guides below consensus, analysts cut models. Lower revenue assumptions flow into lower earnings assumptions. Lower earnings often mean a lower valuation multiple. That's the price investors are willing to pay for each dollar of profit. The stock dropped roughly 2 to 5% intraday, depending on the snapshot. That move reflects immediate disappointment, but it likely doesn't reflect full earnings revisions yet. Those usually come days later as analysts adjust forecasts for 2026 and possibly 2027. Now, zoom out for a second. CEO Marvin Ellison pointed to high mortgage rates, tariff uncertainty, and something called the lock-in effect. Homeowners who refinanced at very low rates don't want to move. And if fewer people move, fewer kitchens get remodeled, fewer decks get built, fewer big projects start. This is a housing story. When mortgage rates stay high, turnover slows, remodeling slows, big-ticket purchases get delayed. That's the pressure Lowe's is describing. But here's where it gets interesting. Management didn't announce margin cuts. They didn't slash dividend plans. They didn't warn of cash flow stress. Free cash flow guidance wasn't formally reset in the release. Capital return plans weren't pulled back. So this isn't a balance sheet problem, it's a demand timing problem, at least for now. The key risk sits in operating leverage. That's a simple concept. When sales grow, profits usually grow faster because costs are spread over more revenue. But if sales stall, fixed costs don't disappear. Margins can compress. If comparable sales land at the low end, flat, promotions may increase. Promotional activity eats into gross margin, which is the portion of revenue left after product costs. If inventory builds too quickly, markdowns follow. That's where profit pressure could emerge. Can cost cuts offset that? Maybe partially. Lowe's has executed headcount reductions before, but cost control only stretches so far if demand softens more than expected. Now shift to competitors. The Home Depot has leaned more heavily into professional contractors, the pro customer. That segment tends to be more resilient during softer consumer cycles. If pro demand holds better than DIY demand, investors may prefer Home Depot over Lowe's in a weak housing environment. That doesn't mean Lowe's is losing market share. It means mix matters. Suppliers and building material producers also feel this. If retailer guidance softens, order expectations often adjust lower. The ripple effect moves up the supply chain. So, is this already priced into the stock? Partially. The 2 to 5% drop reflects immediate guidance disappointment. But if analysts reduce fiscal 2027 numbers, or if housing data weakens further, additional pressure is possible. Is the fourth quarter beat masking a slowdown? Not necessarily. The fourth quarter showed modest positive comps, but guidance suggests management doesn't see acceleration ahead. That's the key shift. Is this a collapse? No. Flat to plus 2% comps is not negative growth. It's stagnation. The difference matters. The big unknown is mortgage rates. If rates fall meaningfully, housing activity could rebound. Remodeling activity often follows. In that scenario, comps could exceed the 2% top end. That would quickly change sentiment. But if housing weakens further, if mortgage applications decline, if housing starts fall, comps could drift towards zero or even negative territory. That's where operating leverage becomes painful. Investors now face a reset question. Should earnings growth assumptions for the next 2 years come down? Likely modestly. Does this reduce dividend growth capacity? Not immediately, based on current guidance. Is the buyback pace at risk? Only if cash flow materially underperforms the earnings range. For ETF investors, Lowe's is a meaningful holding in consumer discretionary funds and the S&P 500. If housing sensitivity rises, volatility in those ETFs can increase. But don't overread it. A cautious guide does not mean earnings are collapsing. A fourth quarter beat does not mean demand is surging. This does not signal a structural balance sheet issue, and it does not automatically mean permanent share loss. It signals uncertainty. What should investors watch next? Monthly housing starts, mortgage application trends, same-store sales in the next quarter, analyst revisions to FY27, any shift in margin commentary on the next earnings call. If mortgage rates drop and comps move above 2%, the narrative flips quickly. If margins expand despite flat comps, confidence returns. But if comps turn negative and EPS slips below $12.25, sentiment shifts harder. For now, Lowe's delivered a good quarter and a cautious future. The market believes the future more than the past, and the next housing data print matters more than anything Lowe's sells in its stores this week.